Hello and welcome to ET Markets. Today we have a very special guest, Mr. Nilesh Shah, who is the Managing Director and CEO of Kotak Mahindra Mutual Fund. A chartered accountant gold medalist with over 3 decades of experience, he is one of the most prominent voices in the Indian mutual fund industry. So, Mr. Shah, can you tell us how do we survive a bear market?
In a bear market, what is the most exciting thing? In the bear market, most exciting thing is that you will be able to pick up stocks at much below fair value. And the money which you can make from a bear market to bull market will be the maximum. So think of this correction bear market as an opportunity to make more money. If there was no bear market, investors' return would have been far, far lower.
So if I have a watch list of stocks to buy, and put it on a watch list, and then how should I go about picking stocks in a bear market? Should I look at stocks that have proven to be more resilient or the ones that have fallen the most?
So in a bear market or a bull market or a range bound market, you have to buy that stocks which you believe are available at a discount to their fair value. Now, investment is an art, it's not a science. I may believe company X is available at 30% discount to fair value. And someone may believe that company X is actually trading at a 30% premium to fair value. If both of us will have same opinion, then how will the trade happen? Stock market is a place where seller thinks he is making money by selling and buyer thinks he is making money by buying. Then only the transactions will happen. So no matter what kind of market you are in, as long as you buy stocks which are representing good businesses where return on equity is more than cost of capital, run by good managers who won't cheat you, who won't take you for a ride, and are available at good valuations where there is margin of safety involved. By and large, that becomes the good stock pick.
We have inflation, we know about inflation, we know about recession, we know about Fed rate hikes. Are all the devils known now?
See, it's like, cricket match. When you go to play cricket, you do know that a bouncer can come, a yorker can come, an off swing can come, an in swing can come. But at the end of the day, when you go on the pitch, who knows what will come? Same way in market, will have to be ready for whatever bowling throws at us. It is the nature of the market that it keeps on discounting various scenarios. So when there was no Russia-Ukraine situation, market didn't know where Ukraine was. The moment it became important, it started discounting it. So today, would market have taken into account higher oil prices, higher inflation, Russia-Ukraine geopolitical situation, US Fed rate movement, corporate profitability? Answer is undoubtedly yes. Market is collective wisdom of people. It invariably discounts all the known things. But there is always an unknown thing which comes and hits market, which we were not aware, which market was not aware.
With Nifty below 16,000 level, do you think we are at a fair price?
So Nifty at about 16,000 level will be about 19 times forward earning post this windfall tax. So it looks like little above fair value, but still nearer to fair value compared to, let's say, in October 21. And this is the market where you will be equal weight to equity allocation based on your risk profile and time horizon and objective. And if market continues to correct, it could be time correction, because if 6 months down the line market is at same 16,000, it has become cheaper as earnings would have gone up. So there could be time correction, or there could be price correction. If 16,000 Nifty becomes 15,000, there is a price correction, or it could be both time and price correction. So in the correction phase of time, price, or both, keep on increasing your allocation to equity.
At a time when the interest rate cycle is changing, how do you think, how is the outlook change for banks?
Banks are generally the beneficiary of higher interest rate as their net interest margin expands. Obviously, there is a cost where higher interest rate does impact mark to market on their portfolio. But at this point of time, we believe benefits of rising interest rates on your net interest margin will be far more than the mark to market losses on your portfolio. More importantly, banks are having 10-year low NPS, and most of it is provided for. And then the final part is that there is consolidation happening in banking sector in terms of growth, where 2-3 public sector banks and 4-5 private sector banks are grabbing bulk of the credit growth. You have consolidation happening, you have a NIM expanding, and you have NPS provided for. I think all this put together creates huge opportunity for banking sector to outperform the market.
One last question, Mr. Shah. Which are the sectors that you're most bullish on at this stage?
Banking is one sector which I'm sure you would have picked up. The other sector which we are bullish is manufacturing. In 2014, India had about 3 or 4 mobile handset manufacturing factories generating about 22,000 crore in revenue. We were net importer of mobile phones to the extent of $8 to $10 billion a year. Fast forward to 2022, we are the second largest manufacturer of mobile phones in the world. We produce more mobile phones than South Korea, Vietnam, US. Today, there is mobile production value of about 220,000 crore. India is now exporter of mobile phones, including iPhone 13, which is now made in India. What happened in mobile handset manufacturing can happen in other manufacturing areas. Indian manufacturing is becoming competitive because our labor cost is lower compared to the rest of the world. From infrastructure deficit, we have become infrastructure available. The government is also supporting creation of manufacturing setup. There are challenges in terms of logistics cost and power cost, but because of the advantages of labor cost and some other infrastructure availability, we are becoming competitive. China plus one is also forcing large multinational companies to seek diversification out of China. The whole world is available to them, but few of them are coming to India. Put all these things together, India will become part of global supply chain management. Government is encouraging manufacturing in India. There is incentive scheme under production linked incentive scheme, which will make manufacturing in India more rewarding. And despite challenges of logistics and power, we are becoming competitive. What we did in mobile handsets will get replicated in many sectors, and collectively we call them manufacturing theme, where we are bullish.
That's all we have for now. Thank you, Mr. Shah, for giving us your valuable inputs and time.